Hello everyone, welcome back to my channel. In the previous video, we systematically explained what the Kondratiev cycle is and why, from a long-term perspective, we are currently in the depression phase of that cycle. This phase does not mean an economic collapse. Instead, it represents a very typical but deeply uncomfortable investment environment. Overall growth is weak, companies are reluctant to expand, capital expenditure remains subdued, and making money becomes increasingly difficult. Many people clearly feel that opportunities are fewer and the overall pace has slowed down. Against this backdrop, a very practical question naturally arises. Where are the investment opportunities? If you're still searching everywhere for exciting, high-growth stories, you are likely to end up with one of two outcomes. Either the story does not really make sense, or the stock price is already so expensive that there is no margin left. History has reminded us again and again that during the depression phase of the Kondratiev cycle, the assets most often underestimated by value investors are not those that paint grand visions of the future, but something far more plain and even a little boring: commodities. To understand why opportunities so often hide in commodities, we need to zoom in from decades-long macro narratives to a shorter cycle that is much closer to actual trading. Today's main focus is the inventory cycle. The economy has never operated like a single isolated gear. It is more like a set of nested Russian dolls, formed by multiple cycles layered within each other. The 60-year Kondratiev cycle determines whether an era's overall backdrop is prosperity or depression. Within one Kondratiev cycle, there are typically 3 property cycles, each lasting about 20 years. Within each property cycle, there are 2 fixed asset investment cycles, each around 10 years. At the very core, and also the shortest cycle, is the inventory cycle, formerly known as the kitchen cycle, usually considered to last around 3 years. One fixed asset investment cycle typically contains 3 inventory cycles. So what exactly is the inventory cycle? Before getting into the details, we first need to clear up a common misunderstanding. The inventory we're talking about here is not the toilet paper you stockpile at home. We are referring to inventories across the entire industrial chain of production and distribution. IT usually includes 3 levels. Upstream raw material inventories, such as copper, ore, or iron, or piled up at ports. Midstream work in progress, meaning products still moving along factory production lines. And downstream finished goods inventories, covering everything from factory warehouses to distributors and retail stores, where goods are waiting to be sold. The key to understanding the inventory cycle is that it represents the most objective response of the manufacturing sector to changes in real demand. Business owners do not plan production based on emotion. They look at their order books and their expectations for the future. The critical point is that this response and adjustment always lags behind reality. There is always a delay. This allows us to define the inventory cycle in a very concise way. The inventory cycle is essentially a short-term economic cycle caused by companies responding one step too late to changes in end demand, repeatedly swinging through the loop of overproduction, inventory digestion, and inventory replenishment. Let me use a simple example to explain how the inventory cycle forms. Imagine you're the owner of a toy factory. At the beginning, the market is strong. Parents are willing to spend money on their children, and toy orders keep coming in. Your strategy is straightforward. Run production at full capacity and build up inventory so you do not miss sales opportunities when popular products sell out. But good times do not last forever. The economy suddenly slows down, consumers become more cautious with spending, and your toys do not sell as well as before. At this point, as a factory owner, what would your first reaction be? You certainly would not shut down production the very next day after seeing sales decline, nor would you immediately lay off skilled workers you spent years training. Instead, you would first use existing inventory to fulfill the reduced orders. At the same time, you would gradually slow down production and significantly cut back on purchasing new raw materials. This process is a classic case of active destocking. During this stage, because demand is weakening, you discount your toys to clear inventory. The market is characterized by falling inventories and falling prices at the same time, and corporate profit margins are severely squeezed. This is the most painful and darkest phase of the cycle. However, this process does not last forever. When toy prices fall to a certain level, positive signals start to emerge. Downstream distributors begin to think, these prices are too cheap. They are far below my previous procurement cost, so I should stock up now to lock in costs. As a result, toy prices gradually stabilize. At this moment, a critical imbalance appears across the entire supply chain. Demand is showing early signs of marginal improvement, but the supply side responds very slowly. As a factory owner, your decision-making is very pragmatic. Expanding production requires capital, and hiring workers takes time. You need to confirm whether this new wave of orders represents a genuine and sustainable recovery in demand or just a short-lived false signal. As demand slowly recovers while factory output remains weak, inventories continue to be drawn down. The industry enters the phase of passive destocking. As inventories keep declining, production eventually falls behind demand. The end result is that prices begin to rise before output and inventories recover. Next, you notice that toy orders keep increasing and your inventory level has dropped too low. If you do not ramp up production, you risk running out of stock. So you start operating at full capacity again to meet demand. At this stage, both toy prices and inventories rise together, and the industry enters the active restocking phase. Commodities and cyclical stocks usually experience their strongest upward move here. This is the phase where asset performance is typically the best across the entire cycle. Eventually, demand peaks and starts to fall again, but production still has inertia. You find that newly produced toys are not selling, and inventory piles up in warehouses almost uncontrollably. This marks the passive restocking phase. Prices come under pressure, corporate profits peak, and you realize that toy demand is weakening once more. This completes a full inventory cycle. You may have already noticed that the inventory cycle lags behind commodity prices. This is the core insight of inventory cycle theory. Prices reflect expectations, while inventories reflect reality, and there is a natural time lag between the two. This valuable time lag is the key opportunity that investors can exploit. Among the 4 stages we just discussed, the most attractive risk-reward buying window often appears in the second stage, the passive destocking phase. Its typical characteristics are that prices have already stabilized or even started to rebound, while inventory data continues to decline. This is the turning point where the economy moves from contraction toward recovery. Market sentiment remains pessimistic, but the smartest capital has already begun to quietly enter. This time gap, where prices move first and inventories confirm later, is the most important arbitrage window in cycle-based investing. So the most important question now is, where are we in the inventory cycle now? Because cycles differ across countries. Let's use the United States as an example. Based on historical data and existing research, we appear to be close to the starting point of a new inventory cycle. This is not a judgment that can be pinned down to a specific month or date. It is a judgment about a time window. The next question is whether there is a real-world price signal that can help us validate this line of reasoning. Among the large family of commodities, if we had to choose just one as a global economic barometer, many professional investors would choose copper. The market even gave it a nickname, Dr. Copper. The reason is simple. First, its applications are extremely broad. Copper is a classic industrial metal. It is essential for electricity, construction, home appliances, automobiles, and machinery. Almost every traditional sector of the economy depends on it. Once the economy starts to recover and manufacturing and infrastructure projects resume, copper demand inevitably rises. Second, copper has a strong new demand narrative, which is critical. The global energy transition, the rapid adoption of electric vehicles, and the ongoing AI boom driven by data center construction are all significantly increasing medium and long-term copper demand. Finally, supply is rigid. Developing a large copper mine, from exploration to production, often takes 10 years or even longer. This means supply naturally responds much more slowly than demand surges. If we apply the inventory cycle framework we just discussed to real market data, we can observe a very interesting and recurring pattern. At the tail end of each inventory cycle, which is the passive destocking phase, prices almost always start to move first. They do not wait until inventories actually bottom out. The previous two major windows occurred in early 2016 and late 2019. In the rallies that followed, copper prices rose by about 60% and 120%. After 2022, the situation became more complex. The AI wave introduced new structural demand, which disrupted the traditional inventory cycle to some extent. This pushed the copper price floor noticeably higher and prevented the deep drawdowns seen in the past. Even so, the familiar pattern still holds. Copper prices once again completed their reversal before inventories truly stabilized. At this point, I need to make one thing very clear. Cycle theory is not a crystal ball that can precisely predict the future. It is more like a map, not a clock. It can tell you the general direction and roughly where you are, but it cannot give you an exact arrival time. In the real world, inventory cycles that appear orderly are often disrupted by unexpected events. So please remember this. The inventory cycle is not a magical ruler that tells you copper prices will rise next month. It is a framework that helps improve decision-making odds. It gives you an anchor to understand your position in an uncertain market, not a precise timing tool for buying and selling. During the depression phase of the Kondratiev cycle, commodities, especially core industrial metals like copper, often deserve close attention. Supply adjusts slowly, while marginal changes in demand tend to lead. This gives prices strong elasticity during cycle transitions, and that is where investment opportunities emerge. Although copper prices have already risen quite noticeably, and the gains are not small, from an inventory cycle perspective, this trend is still likely in its early stage and not yet complete. Based on this view, I personally would choose to allocate a small portion of capital and participate gradually over a longer time horizon to manage uncertainty. This is not investment advice. It is simply my own thinking and approach based on the cycle framework. If today's discussion on the inventory cycle was helpful to you, I would really appreciate a like and a subscription. Make sure to turn on notifications so you do not miss our next practical discussion on asset allocation. I will see you in the next video.